Hey everybody, John Bowens here from Equity Trust Company in another whiteboard session. Today we're going to be talking about the frequently asked questions on the health savings account. We're going to call it the HSA going forward. For those of you who aren't familiar, a self-directed health savings account is just like any other health savings account. It's a tax-advantaged account available to individuals or families that have a high deductible health care plan. So that's important for everyone to understand, is that you must have a high deductible health care plan in order to qualify to contribute to a health savings account. So let's talk a little bit about, first, self-directed HSA. So when you hear self-directed HSA, think you have the ability to take full control. And this is why investors that we find here at Equity Trust Company want to take advantage of a health savings account with our firm, is they want to invest in more than just stocks, bonds, and mutual funds. They want to invest in real estate. They want to invest in real estate partnerships. We'll give you a case study in just a moment of a client that did just that. They want to invest in notes. They want to invest in precious metals, or a variety of other alternative investments. All right, so let me jump right into a quick case study. We have a client here by the name of Mark. He set up a health savings account. He, in fact, had monies from a health savings account with another financial institution, and all he did was transfer that health savings account over into a self-directed HSA plan. So that's important to know as well. If you're somebody that already has a health savings account with another financial institution, all you need to do is simply transfer that over into a self-directed HSA. So this gentleman, Mark, invested $20,000 from his HSA in a real estate investment partnership. It was for a commercial real estate opportunity. He ultimately was investing alongside a group of other investors. And so this $20,000 investment in just 2 years yielded a $38,000 tax-free profit. See, with the HSA, when you put money into the account, generally speaking, you get a tax deduction. It grows tax-free, so in Mark's case, he made $38,000 tax-free. And when he distributes that $38,000, providing that he's using it for its intended purpose, which is for healthcare-related expenses, it's tax-free. And if you're interested in knowing exactly what qualifies as a healthcare expense, you can go to the Internal Revenue Code directly and read up further on this, or you can go to the applicable IRS publication. You can visit irs.gov for that information. All right, so you got an idea of self-directing an HSA. All right, let's talk about eligibility. Now, I mentioned before, you have to have a high deductible health care plan. So what does that actually mean? Well, we have up here, if I can draw your attention to the whiteboard, in 2019 and 2020, you'll see the minimum deduction and out-of-pocket expense. Now, we're not necessarily going to get into the details of each individual one. The best way to know whether you have a high deductible healthcare plan or not, and you can certainly follow along with these numbers, but talk to your healthcare policy provider, or even check with your CPA or accountant. All right, so check with your healthcare policy provider and just ask them, is this a high deductible healthcare plan or not? And they likely will be able to instruct you on whether it is or not, and if you qualify for a health savings account. Again, you could transfer over monies from an existing HSA, and if you qualify, you can also make a contribution. So with that, let's dive into the contributions. How much money can you put into one of these health savings accounts? Well, we'll go to the far right here. In 2019, you'll see the contribution limits, $3,500 if you are under the age of 55 and it's a single policy, meaning it's just you, right? It's just you covered under that policy, $3,500. And if you're 55 and over, you'll see that the government gives you what's called a catch-up provision. You can put an extra $1,000. So that's $4,500 if you're 55 or older. Now, if you have a family policy in 2019, you'll see you can contribute $7,000 and $1,000 is a catch-up if you're 55 and over. And then in 2020, you'll see that those limits have increased slightly. So $3,550, you bump up $1,000 on the catch-up contribution, and $7,100. Now, let's use the example of someone who is 55 or older. They have a family, maybe it's them and their spouse, or them and their spouse and their children. They can put a maximum of $8,100 potentially in that health savings account. And remember, with a health savings account, you get a deduction for the contributions. You get tax-free growth through your investment activities, whether it's real estate partnerships or flipping properties or rentals, whatever it is that you're doing. Could even be stocks, bonds, mutual funds. And then all of your distributions, so as long as it's used for healthcare-related expenses, are tax-free as well. So as you can start to see here, this is painting the picture of this can be potentially a very powerful savings tool for you and your family, for your healthcare needs. And we haven't even gotten into, we have an entirely different YouTube video all on partnering self-directed accounts. So you can actually learn about partnering your HSA for you and your family along with your IRA, or your HSA with your Roth IRA, or your HSA with another investor. Okay, so what can it be used for? All right, well, healthcare related expenses. All right, so think prescriptions, chiropractor, psychologist, weight loss programs. If you want more details on this, what does it include? Oh, by the way, even dental treatment. And there are reimbursement provisions. You can read into the Internal Revenue Code, which means you can pay for an expense and then have the HSA reimburse you. To get more details on this, just go to the irs.gov website, irs.gov, and search health savings accounts and what ultimately would be applicable healthcare related expenses that would qualify under the HSA program. Again, keep in mind the triple the tax benefits, right? Contributions going in, depending on if it's single or a family policy, tax-free growth, and then of course, tax-free distribution, so as long as it's used for qualified healthcare related expenses. All right, so how to open a health savings account? Well, it's pretty simple. Just like Mark, who I mentioned before, who made the $20,000 investment, made $38,000 in profit, he had an HSA with another financial institution. He transferred that over into a self-directed HSA with equity trust. Other folks might want to just set up a new HSA and make a contribution. See, just like an IRA, you can have an HSA with another financial institution and then an HSA with equity trust company. All right, you're not going to be limited. You just can't max out the annual contributions on an annual basis. All right, so HSA with another firm, HSA potentially with equity trust company, or just have the HSA with equity trust company. It's a very simple form to complete. You can also do this electronically. You can reach out to an equity trust staff member, give us a call or send us an email, and we can assist you through the process to open and fund your very first health savings account. And then from there, ultimately you're off to the races in terms of being able to invest with the HSA, and really you're only limited by your own creativity. Last but not least, as I always say, and we have lots of other YouTube videos that talk about this, is compounding interest in the absence of taxation. That's what this is all about, is growing the HSA in a tax-free environment and ultimately being able to use that for your long-term healthcare related expenses. If you haven't already, subscribe to our YouTube channel. We release videos on a frequent basis, so if you subscribe every time we release a new educational video, we'll push that out to you. We look forward to seeing you folks on the next whiteboard session.